Hello investors! Are you looking for a way to earn passive income during times of uncertain market volatility? In this video, I'll go over how dividends work and how they can be profitable even during times of rough market conditions. A dividend is a portion of a company's profits that is given as either stock or cash to shareholders. It is often paid on a quarterly basis as a gift to investors. The declaration of a company's intention to pay a dividend on a specific date is as good as a promise, unlike the share price, which might fluctuate from day to day. Dividends are a tool for shareholders to contribute to and benefit from the expansion of the underlying business, in addition to the rise in share value. Dividends paid out in cash or shares of stock are the two ways that the profits are distributed. Ex-dividend date. Which stockholders will be eligible to receive the dividend is determined by the ex-dividend date. Shareholders are required to own the stock at least one business day before the ex-dividend date. A dividend will not be paid to stockholders who acquired the stock after or on the ex-dividend date. Dividend stocks versus dividend funds. The two major ways to invest in dividend stocks are through mutual funds that hold dividend stocks, such as exchange-traded funds or index funds, or by buying individual dividend stocks. You can own a portfolio of dividend stocks with just one transaction if you use dividend ETFs or index funds, which give investors a wide range of dividend firms inside a single investment. You will then get regular dividend payments from the fund, which you can either use as income or reinvest. The benefit of dividend funds is rapid diversification. You can still count on income from other stocks in the fund, even if one of the holdings reduces or suspends its payout. Investors who select individual dividend stocks are able to build a unique portfolio that may provide a higher yield, despite the fact that doing the necessary research on each stock to make sure it fits into your entire portfolio takes more time. Dividend stocks may also result in lower costs because investors pay an annual fee known as an expense ratio when using ETFs and index funds. Most dividends paid to shareholders in the United States are cash dividends, which are payments given in cash on a per-share basis. For instance, an investor holding 1,000 shares would receive $200 in cash if the corporation paid a dividend of 20 cents per share. A percentage increase in the number of shares owned is what constitutes a stock dividend. If a corporation distributes a 10% stock dividend and an owner has 100 shares, following the payout, the investor will own 110 shares. Dividend yield. The dividend yield is a metric for calculating how much cash flow you receive for every dollar invested in an equity holding. In other words, it's a gauge of the value you're obtaining for your money via dividends. The return on investment for a stock without any capital gains is effectively represented by the dividend yield. By dividing the dollar amount of dividends paid per share in a given year by the dollar amount of one share of stock, the dividend yield is expressed as a percentage. For instance, if a company's annual dividend is $2 and its stock is trading at $50, the dividend yield would be 4%. Beware of too high dividends. Handing out large dividends might limit a company's ability to thrive. Each dollar a business pays out to its shareholders represents money the business isn't reinvesting in order to generate capital gains. Consider why a yield might be high before doing a little research. Sometimes a stock's price collapse leads to a high dividend yield. A situation known as a value trap will arise, since the yield will logically increase as the price falls. Discover the cause of the stock's price decline. Do your research to be sure, but you might want to avoid this investment if the company is having financial difficulties. Payout ratio. A crucial financial indicator used to assess the viability of a company's dividend distribution policy is the payout ratio. It is the ratio of a company's total net income to the amount of dividends given to shareholders. For example, if a company's net income is $100 million and it paid $30 million in dividends, the payout ratio would be 30%. In general, the sustainability of a payout ratio increases as it rises, especially if it exceeds 100%. On the other hand, a low payout ratio may indicate that a business is putting the majority of its profits back into growing its business. Companies with the finest long-term dividend payment records typically maintain stable payout ratios over a lengthy period of time. Dividends are not assured until they are announced. The board of directors of a firm has the authority to lower or even remove the dividend at any time, unlike a bond, which must make the agreed-upon payment or be considered in default. Although dividends aren't always paid, they remain a major source of income for many investors. Retirees can plan to get a dividend check every month of the year as corporations pay the dividends at different periods. Younger investors who might not require the income right away might reinvest their dividends to put them to work right away in their portfolios. Although dividend reinvestment programs automate this procedure, dividends are still taxed in the year you receive them, even if you reinvest them. Dividends in tax-advantaged accounts, such as individual retirement accounts, where money grows tax-free until it is withdrawn, are the exception. Investors are eligible for lower capital gains taxes on their dividend income if they held their dividend stock for more than 60 days prior to the ex-dividend date, which is typically one business day following the date you must own shares in order to receive the dividend. Bond interest is always subject to ordinary income tax. When interest rates are low, dividend stocks frequently offer better yields than bonds, while also providing the possibility of share price growth. If you reinvest those dividends, a lower share price offers you more shares per payout, so even if the price drops, the dividend can protect a portfolio with consistent income. Those are just a few ways dividend investing can help grow your portfolio. Please check out the channel for more content on investing.